Some breaking news from the Bank of Canada. They have surprised the markets and raised rates by 25 basis points. 25 basis points.
The Bank of Canada has raised interest rates again.
Will this trigger a recession?
Interest rates increased again, and today we are going to talk about why interest rates increase, what's the difference between fixed and variable rates when it comes to increase, what triggers those increases and reductions, and what it means for you and me. So let's get started. So in today's presentation, we'll be talking about the basics. Why do variable or fixed rates increase? The reasons are slightly different and it's not just linked to inflation. We'll also talk about the inevitable economic pain. Then we'll also talk about what these interest rates actually mean and why it could cause future economical pain, which may or may not impact the housing market, but it will impact you and me. And finally, we talk about how should you be prepared for it and should you buy real estate today or not. First, let's talk about variable rates. As the name suggests, the rates actually change with Bank of Canada increasing the prime, which is what happened yesterday. It was yesterday for me. I'm shooting this video on June 8th. So June 7th, the interest rate hike happened. If you have been following news, you know that there has been a lot of hikes, and if you are a homeowner, you have actually felt the pinch of it. Now let's try to understand what happens in the economy and why is it that the variable rates are increasing. So the chart that you see on the screen is basically the money supply that is there in the economy, and we all know what happened during COVID when there was a lot of unemployment, when there was a lot of uncertainty. The banks printed a lot of money and gave it away to people. That means the money supply in the market increased to 5 times. That's amazing. If you look at the entire trend, way past 2014, the money supply has been at a very steady pace. It has just grown at a very steady pace, which should be the case. And suddenly there was so much printing of money. And what that caused is more spending. What happened in 2021, 2020 is people actually had more money. Even if they did not have jobs, they had more discretionary spending. Cost of goods temporarily actually came down. And with the increased spending and all the supply chain issues that we had during COVID, the demand went up way more than what the supply was. And that jacked up the prices of everything, which is what essentially inflation is. Everything gets more expensive. So the ideal spot is about 1 to 3%. 2% is what Bank of Canada always targets for inflation. However, our inflation levels increased to more than 7% at one point in time. And then Bank of Canada started increasing interest rates, and that caused the money supply to reduce a little. It has come down to about 40% of what it was at the peak when the money was being printed and peak of COVID. The money supply is still 3 times what it should be or what it was pre-pandemic. And therefore, even though the inflation has come down, the inflation has not come down too much. We can actually feel a lot more than 4%. Groceries have increased, car payments have increased, house prices we all know have increased. And that's what is causing slowdown in demand, which is what the government actually requires. Now, if we overlay inflation numbers with the Bank of Canada interest rates, we saw that during the pandemic, when the pandemic just hit, they reduced the interest rates so that more people can buy houses. The demand still remains and the economy doesn't tank. And then Bank of Canada started increasing interest rates. That made affordability really low. The spending reduced, the demand reduced, the prices are still high, and the interest rates remained low for 2 years, which gave enough breathing space for people. The amount of savings that people did also increased because the mortgage payments were very low because of the low interest rates. Plus, people were not really going out because of the pandemic. And then in 2022, Bank of Canada flipped their narrative and they started increasing interest rates. The inflation levels were at a sky high of 7%, and then slowly it started to come down because the spending had reduced, because affordability was a problem. Interest rates had gone up, house prices were going up, car payments were going up, and all that put downward pressure on inflation. However, the rate at which the inflation has come down is nowhere close to what it should be, and that's the reason why Bank of Canada continues to increase interest rates. So as you can see, inflation has a massive role to play when it comes to variable rates and prime rate, which is where now we are standing at 4.75% of benchmark rate. Now, you would say that your mortgage payments are a lot higher than 4.75%. If you take a variable rate right now, it's upwards of 6%, sometimes even 6.5%. This 4.75% is the cost of borrowing for a bank when they are picking money from the market. Then they add some margins to it because the banks need money to operate. They have branches, they have people who are doing mortgages, they have people who are doing retail banking. So they have to add margins to it, and then they get a variable rate. And that's the reason why your variable rate is about 6% when our benchmark rate is about 4.75%. Now, this particular rate hike on June 7th was kind of expected, but people were thinking that it will only happen in July. Now, Bank of Canada also said that they might increase the interest rates again, which is a very real possibility because I think the 4% number is really high still. And I think it will take a lot more for us to come back to 2% inflation than just one interest rate hike. And what all this is doing is your mortgage payments have actually increased. Let's say you bought a 1 million home at 20% down. At a 30-year amortization, your mortgage payments were 2,750. Your overall carrying cost of the house, including property tax, maintenance, and everything, was 3,750. I've just added $1,000 of other costs that you have when you're owning a house. Your gross income that you needed to buy this house was $160,000, and your net income comes to about $10,000 after taxes. That means that you were spending about 37% of your net household income that you are getting after taxes into your mortgage and house related expenses, which was very, very comfortable. And which is where things have just completely flipped. The mortgage payments have gone up by over $2,000 if you're in an adjustable rate or a variable rate. The carrying costs have now increased to over $5,700. You need a gross income of now $200,000 in order to sustain this. This basically means that you now need 25% hike in your gross income in order to make these payments. That comes to about $12,000 of net income. That still means that around 50% of your net income is now going towards mortgages, and that's where people are feeling the pinch. And for some people who are in the tech industry, or if your incomes have not increased because of the environment that we are in right now, we are still at $10,000 of income, but our expenses have increased to about $6,000, which basically means that our home-related expenses have gone up from 37% to 60%, which is really high, and that is causing a lot of pain. Now we know that Bank of Canada can influence variable rates by increasing prime rates, and that reduces spending in the market because affordability is a problem, because now house-related expenses are taking a lot more out of our paycheck, and therefore we are spending less on other things, and that would get the inflation down. Hopefully, at least that's the hope of Bank of Canada. However, fixed rates work very differently, and we don't have to wait for Bank of Canada to say that yes, the benchmark rate has increased and therefore we need to increase fixed rates. Fixed rates work on the bond yields. Now, bond yields are basically nothing but we are investing in the government. When the sentiment is that the government is doing very well, the economy is doing very well, people invest in government bonds. When a lot of people do that, the bond prices increases because the value of the bonds have now increased. When bond prices have increased, the rate of interest in that bond goes down, and therefore the fixed rates go down, which is what happened when Silicon Valley Bank collapsed. Because the sentiment was that banks are not doing well, Silicon Valley Bank has collapsed. There are 3 other banks like Signature Bank that also did not do well at that time, and that was the reason why they did not have confidence in the market. People did not want to put their money on banks and in the stock market, and therefore they wanted to safely put their money into government bonds, which is what led the bond prices to go up, the yields to go down, and fixed rates came down with them. So this is the 5-year bond yield for the Canadian market, and we can see during the pandemic the bond yields were very low, therefore the fixed rates were very low, and then there has been a steady increase in the bond yields, therefore the interest rates have been going up, even the fixed rates have gone up. There is higher inflation, and of course because of high inflation and the loom and doom of recession, people have less trust on the government bonds, and therefore the bond prices are going down, and therefore the yields of those bonds, just to make them more desirable, are increasing, and which is what increases the fixed rates. Now usually fixed rates should not be going up and down so much, but because we are in an extreme situation where there is a non-recession recession, that's what a lot of people are saying, there are tech job losses, fixed rates have been fluctuating a lot. For example, if you look at this March 2023, they just plummeted. This is where Silicon Valley Bank collapsed, and then soon after 3 other banks collapsed, and then the market did not have trust on the government, which is where people actually trusted the government more, and therefore they put money in their government bonds, and therefore the bond yields started to go down, which is where in March, April and May, when there was this sentiment in the market where the banks may collapse, the fixed rates were more than 1% cheaper than variable rates. A lot of my clients got into a 3-year fixed rate mortgages, and they are really happy with that because now the interest rates have started to go back up again because the inflation numbers came in a lot higher than what were expected, and then US also reached the debt ceiling, and all that just compounds into higher bond yields again because now people are again not investing in the bonds, and therefore the bond yields go up, and therefore the fixed rates are again going up. All this to say that yes, inflation has an impact on fixed rates, but it's not a direct impact. There's more to it than just Bank of Canada saying that we need to reduce the interest rate to 2%. There are other economic indicators and sentiments that also play a role when talking about the fixed rates. So the question is, should you go for fixed or variable rate? My recommendation is it depends on your goals for the house. If you're flipping a house, if you're renovating the basement, if you're doing any of the short-term activities that can increase the house value, then you should go for a variable rate because the penalties are low. But if you're buying to stay in it, if you have a long-term play for the house, then you should go for a 3-year fix. I would still not recommend going for a 5-year fix, even if it's slightly cheaper, because blocking your rate for 5 years at a 5% plus level will be a really high number. The 10-year average of interest rates is about 3.5 to 4%. So if you block yourself for 5 years, the penalties that you pay just to get the lower interest rate when the market gets better will be a lot higher. Therefore, for first-time home buyers, my recommendation is still to stick with 3-year fixed rate, but always talk to your mortgage agent because your situation can be very different from a general situation. Now, with all these interest rates hikes, why is Canadian real estate not crashing? Why is it so resilient? We have seen so many videos that suggest that Canadian real estate is in a bubble, but that bubble doesn't burst. The facts are that 79% of mortgages are on fixed rate. That means all these hikes in rates, if your mortgage has 2 or 3 years left in it, it's not really impacting 80% of Canadians. Only 20% are being impacted. And most of those 20% actually came in the last 3 years during the pandemic. Moreover, a lot of people are saying that we are in a recession, but one of the indicators of a recession is high unemployment. But we do not see high unemployment. Yes, the unemployment numbers were very high during the pandemic, but they have been steadily going down. And you can see that in the last few months, it has been very, very steady at around 5%. So unemployment is not very high. Yes, there are certain jobs that have been lost in the tech space, but that has impacted US more than Canada because Canadian economy is mostly dependent on oil, natural gas, and banking. Now, when it comes to housing, the other problem is that the inventory plays a really big role. But if people are not selling houses, there'll be less inventory in the market. With all the immigration that has happened, all the people who are in the market to buy, all the first-time home buyers, and most of you are actually watching this video as well, you're all wanting to jump into the market and buy and not rent. We'll talk about that in a bit as well. But all that is just not panning out because there are 20% less houses in the market right now. And therefore, despite high interest rates and more people qualifying for less and less mortgage, there still is a lot of demand and the market keeps going up. It's a simple demand and supply issue that we have in the Canadian economy. We have always had that. And all this compounds further because Canada welcomed over 1 million immigrants last year. The population grew by 1 million. There are 1 million more people who are looking for housing, and there are 20% less houses in the market. What do you think will happen? So on one hand, Bank of Canada is increasing interest rates to reduce demand in the market. However, with more people coming in, the demand is just being overcompensated, and which is why the GDP is actually not reduced. One of the indicators, and one of the most important indicators when it comes to recession, is that your economy should be in negative GDP growth for 2 or 3 consecutive quarters, which has just not happened in the Canadian economy. I, for once, do not envy Bank of Canada because they have an impossible decision to make. They have to reduce the inflation numbers at one end, and they also need to make sure that we do not go into a deep depression and unemployment doesn't increase. But a lot of people have been talking about the doom and gloom. I personally feel, and I'm just a random guy on YouTube, I personally feel that we'll need a lot more economic pain for us to get out of this. And there are so many articles in the market which are saying that we will see the worst. RBC projects that unemployment rate will actually increase to 6.6% by 2024 and insolvencies will jump to 30%. Those are really big numbers by a very reputed bank. Now, there are some people saying that this obsession to get the inflation down to 2% is actually unfounded. The 2% rate can be 3%, it can be 4%. We just need to come to terms with reality. But honestly, you and I do not have control over these policies, and therefore we can only prepare our situations to be a lot better if there is doom and gloom that's ahead of us. Now, my opinion is that in order for the real estate to crash, we really need a lot more economic pain in the market. Now, here's a scenario where the real estate can actually crash. Let's say the interest rates increase to a level where housing becomes completely unaffordable. People who have variable rate mortgages have 55-60% of their incomes going into house-related expenses, sometimes even more. There are less buyers in the market because less people qualify at such high interest rates. They'll not have enough discretionary spending left after their house-related payments, and therefore it will cripple spending a lot. And interest rates don't just impact the housing market, that also impacts business loans because people take a lot of business loans. They get a lot of venture debt and venture capital to run these startups. Now, these expensive loans, along with the crippled spending in the market, will lead for businesses to slow down. Now, if unemployment reaches to a certain level, the problem will be that we lose our jobs, and therefore we will have a really hard time making monthly payments and even making monthly rents. And that would lead to more inventory in the market because all the investors whose tenants are actually not paying rent, they would have to forcefully sell the houses because they are not able to make monthly payments. And because of high unemployment, there will be a lot less buyers in the market. So the supply of housing will increase and the demand for housing will get down. And that would lead to the real estate crash that everyone has been waiting for. All this to say that if we are expecting the real estate to crash, we should also be prepared for high unemployment rates. That means that we should be prepared to lose our jobs. And therefore, we need emergency funds. We need to be able to keep our expenses a lot lower so that we are a little more resilient during this economic pain. So the question is, should you buy a home now? And the answer is do you earn enough? Because the reality is, in order to buy an average home, an average starter home in Ontario and BC, you need upwards of $200,000 of gross household income, and that is just to buy a decent house in a decent neighborhood. Even for markets like Calgary and Halifax, where the purchase price is much lower, you still need over $100,000 of household income to purchase a decent home. Which is where, when a lot of people reach out to me with less than $100,000 of household income and want to buy a house in Ontario, most of the times the answer is that you cannot buy till your income levels are high enough. Now, I'm not saying this is fair. All I'm saying is that's how the market is right now, and it's extremely unfair. Therefore, when a lot of people reach out to me with less than $100,000 of household income and wanting to buy a house in GTA, the answer is, in most cases, is you cannot buy a house right now. And the reason is that it's just too unaffordable in these cities, because this is the reality. With the interest rates that we have and the house prices that we have, it's just virtually impossible for you to buy a house with less than $100,000 of household income in Ontario. The second question that you need to ask is your job secure? Because I see a lot of people who are still in probation wanting to buy a house. I would not recommend that. This is a time where we might go into a deeper recession and people will be laid off, and therefore you need to be very sure that your job is secure before you are buying a house. And the third one is, do you have an emergency fund? And that's an important one, but you might also have to forcefully sell your house or go into a foreclosure, which is where whoever comes to me, I always tell them to buy when they can afford it. Not look at the market, look at themselves, look at their emergency funds, look at their situation, look at their job security, and then buy a home. Now, a lot of my clients are making upwards of $200,000 of household income, but they are buying condos. And the reason is that it's okay to start small. Now, there is a common misconception among a lot of people that condos don't appreciate. That's entirely not true, because I have two houses in Kitchener. One is in downtown. If you have been following me on Potato Talkies, you would know that. We bought that for $420,000. It's a 1+1 condo. We bought it in February of 2021. And this particular townhouse that I'm living in, that's a 3-bed townhouse with a finished basement. And that we bought around the same time in December of 2020 for $650,000. And both of these things at the peak of the market increased by almost 46 to 48%. And right now, they have almost grown by the same amount after the market has actually stabilized. Now, this was peak of last year, which is April of 2021. But right now, they are still worth about 30%. And there's absolutely no difference in my appreciation when it comes to condos versus townhouse. But the important thing to understand here is that my townhouse is in a suburb, whereas my condo is right in the center of downtown Kitchener, right opposite Google's office. Therefore, it rents very well, and therefore the property value holds. Because full disclosure here is that do not buy a condo in a substandard area. If you're buying a condo, you need to buy it in a city center, downtown Mississauga, downtown Toronto, Etobicoke. The other argument against condos is condo fee is a waste, and that's not true, because purchase price is also very low. If you're buying a condo, let's say a 1+1 or 2-bedroom condo, it will cost you $600,000. That means your mortgage payments will be a lot lower. Down payment will be about $60,000. So the main difference is the purchase price to start with. $600,000 for a condo and $800,000 for a starter home. And your mortgage payments will be a lot different just because of the purchase price. $3,400 for a condo versus $4,750 for a house. And then let's assume the property taxes to be $250. Obviously, the condos will have slightly smaller property taxes than a house. Condo fee for us, and these are actually real numbers, for us, the condo fee was about $550. And obviously in this house, we do not have any condo fee. Utilities plus insurance is a lot higher in a house, because now you have to pay for all your utilities, water, we have to pay for that. The insurance and everything becomes really expensive, and we are paying almost 3 times of what we were paying in a condo, where condo fee included all the utilities except for hydro. And then there are other things like gym. For example, I had a free gym in my condo. Here I've actually made a gym in my garage. First of all, I don't have any garage space right now. Also, I had to spend a lot of money to create that gym, or I had to go to the gym and spend $50 to $60 there as well. Plus, when you are living in a bigger house with 2 or 3 bathrooms, there is a leakage. You need to call a plumber, you need to do electrician. Therefore, your maintenance cost in a house is a lot higher. All this taken together, you will see that condos are only $100 more expensive when you combine all the maintenance, utilities, and condo fee versus a home. So there's not much of a massive gap, and condo fees are actually not a waste. But overall expenses are 31% lower when you buy a condo versus a house. Now, I'm not saying that this is for everyone. Some people have kids and therefore they need bigger space. But people who are single, or they are a couple not expecting any family to come from India, or they are not planning a family right now, it's important that you talk to someone and do your numbers between condo and a house and take the right decision for you. Now, the other argument that a lot of people make is, no, I cannot afford a house, but I cannot do renting as well because renting is a waste of money. That's not true, because your overall expenses in a household will be about $1,800 if you do not have kids. This includes all your car EMI, insurance, everything apart from the house. And then if you are renting a house, you will be paying a $2,800 rent for a decent townhouse. At least in Kitchener, you will get that. Utilities will be $70. Tenant insurance is about $30. Internet is about $35. So your overall expenses will be less than $5,000, including the non-shelter expenses as well. But instead of renting, if you're buying a similar house, you will know that your mortgage payment in itself has increased by a lot. In fact, your interest payments are actually more than your rent that you are paying. You have your property tax and utilities that are a lot higher when you are buying your own house, because now you need to pay property taxes as well. Your insurance increases because you need to now take a fire insurance as well. Your internet charges increase because now you don't have the economies of scale that you have in a condo. Your maintenance also goes up because now you're responsible for everything that goes wrong in your house, and your overall expenses will increase by over 50%. So you need to be really ready income wise and your job security wise if you are making the move of renting to buying. Now, I'm in no way saying that renting is better than buying in the long term. In the long term, your wealth will grow a lot faster and you would want to be mortgage free at the end of 30 years. But in the short term, if your expenses are not allowing you to buy a house, don't. It's okay to pay someone else's mortgage. That should not be the only reason why you buy a house. Or the alternate is that you move to a smaller state like Calgary, where you can find a duplex for $600,000, whereas your townhouse in Ontario without a duplex, a small one, will be $800,000, and the numbers would make a lot more sense. Your mortgage payments will be a lot lower. All other expenses, even if I include all other expenses and I keep them the same, you will get rent from basement because you are getting a duplex in Calgary, whereas you are not getting anything from your basement in Ontario at $800,000. Therefore, your household expenses will reduce by about 85% if you move to Calgary. Now, this again is not for everyone, but just something to think about. The reason why I'm talking about all these options is because it's really important that we don't get bogged down with our home payments and we stay happy. The reason why we bought a house is because we wanted to make happy memories in it, not have buyer's remorse when you buy a house. And that's what is happening to a lot of people right now because they just bought more than what they can afford. I hope this video gave you some insights on how fixed rates and interest rates increase. If you're a first-time home buyer looking to buy a house in the next 12 months, I would highly recommend that you book a call with me. We make a strategy. We make sure that we do not make any rash decisions. We do not max out on our eligibility. We make sure that we are buying a house when we can afford it. So when you're booking a call with me, I'll not be the guy who will only be taking you through the number that the bank gives. I'll actually be making a strategy with you that would put you in a house that will still make you happy. And sometimes the answer is just that you are not ready to buy a house, and that's also okay. That's all I have for today. मिलते हैं अगली वीडियो में. तब तक के लिए बाय बाय.